I want to start this episode with a thought experiment. Imagine you wake up tomorrow morning, and the first thing you see when you reach for your phone is a wall of red. Breaking news alerts. Market futures are down 4%, then 5%, then 6%, and somewhere in the middle of all those notifications is the one that explains why. Conflict has broken out. A war has started. Maybe it is somewhere far away. Maybe it feels closer to home. But the markets are reacting, and your portfolio is bleeding, and every financial pundit in the world is suddenly on television telling you what this means. What do you do? That is what this entire episode is about. Because this situation, war, geopolitical crisis, military conflict, is the single scenario that causes more investors to make catastrophically bad decisions than almost any other. Not because they are stupid, not because they are not paying attention, but because in that moment, everything they feel tells them to act, to sell, to get out, to stop the bleeding and protect what they have built. And almost every time that instinct is wrong. Today we are going to talk about why. We are going to look at the real historical data, not the cherry-picked anecdotes, but the actual record of what markets do when wars begin. We are going to talk about the psychology that makes us want to panic sell and why that psychology, which served our ancestors well on the savannah, is actively working against us in the modern financial world. And we are going to build you a real, practical framework for what to do, and critically, what not to do the next time the world feels like it is falling apart. So let us get into it. Let us start with the facts, because the facts in this case are genuinely remarkable, and they run completely counter to what your gut is going to tell you in the middle of a crisis. Here is the core truth. In almost every major geopolitical crisis of the last 100 years, investors who sold out of fear and moved to cash ended up worse off than investors who did nothing. And in many cases, significantly worse off. That is not an opinion. That is what the data shows repeatedly across very different kinds of conflicts in very different global environments. Let us walk through some of the most important examples. I want to go through these carefully because I think the specific numbers are important. They give you something real to hold on to when the emotion hits. Start with World War II. When Germany invaded Poland in September of 1939, the world held its breath. But here is something that surprises most people. US stock markets actually rose in the immediate aftermath of that news. Why? Because investors quickly concluded that America was going to be supplying the war effort. The wartime industrial economy was going to be enormous. Companies were going to profit from it. And they were right. By the time the United States formally entered the war after Pearl Harbor in December 1941, the Dow had already been climbing. The market looked past the horror of the moment and saw the economic reality beyond it. Pearl Harbor itself is a more instructive case. That was a genuine total shock. An attack on American soil, thousands killed in hours. It is hard to imagine a more terrifying moment for investors. The Dow dropped roughly 4.5% in the days immediately following the attack. For perspective, your heart would have been pounding watching that number fall. But within months, not years, months, the market had fully recovered. Investors who sold at the bottom of that Pearl Harbor panic locked in real losses and then watched the market climb back past them without them on it. Move forward to 1950. North Korea invades South Korea, and the United States commits to a military response. Markets dropped nearly 13% over the following weeks. 13%. That is terrifying to watch in real time. People were convinced this could escalate into World War III, that the Soviet Union would enter the conflict and the whole thing would become a nuclear standoff. And yet, 12 months later, markets had not just recovered. They were higher than before the war started. The investors who held on made money. The investors who sold locked in losses. Fast forward to 1990. Iraq invades Kuwait in August, and suddenly the Persian Gulf is the center of the world's attention. The S&P 500 falls about 16% over the next few months as uncertainty builds. Then, in January 1991, the air campaign begins. And here is what happened. The moment it became clear that the conflict would be decisive, that America and its coalition partners were going to win, markets staged one of the fastest recoveries on record. The entire decline was erased within months. If you had sold at the bottom of that panic, you missed one of the quickest bounce backs in market history. And then there is September 11th. I mention this one specifically because it is within living memory for most people listening right now. It is the one crisis where you can actually remember how it felt, not just read about it in a history book. When the attacks happened, markets closed for several days. When they reopened on September 17th, the Dow dropped 7.1% in a single session. It was, at that point, the largest single-day point drop in the history of the index. Within 4 days, the index had fallen 14% from its pre-attack close. And then, in the following weeks, it climbed back. By November, the losses were largely recovered. By the end of 2001, the market had regained most of what it lost in those terrifying days after the attacks. The investors who held on or who bought more during the dip came out ahead. The ones who panic sold in that first week locked in losses they never needed to take. Most recently, when Russia launched its full-scale invasion of Ukraine in February 2022, global markets sold off sharply. Oil prices spiked, wheat futures went haywire, and financial commentators talked about the specter of a wider European conflict. And yet, the US stock market, after its initial drop, began recovering within weeks. Not because the war ended. It did not end. But because markets had already begun pricing in the new reality and looking past the initial shock. The pattern across all of these events is strikingly consistent. Shock, sharp decline, recovery, and for anyone who stayed invested through the fear, eventual gains. The question is not whether this pattern will hold in the future. No one can promise you that. The question is whether the historical record gives you a stronger basis for holding than for selling. And the answer, emphatically, is yes. So if the data is this clear, why do so many people still panic sell? Why, if we can look at Pearl Harbor and 9/11 and the Gulf War and see over and over again that holding was the right call, do investors keep making the same mistake? The answer is buried deep in our neurology, and understanding it is just as important as understanding the market data. There is a concept in behavioral economics called loss aversion. It was developed by two psychologists named Daniel Kahneman and Amos Tversky, and it eventually won Kahneman a Nobel Prize. Their research showed, through rigorous experimentation, that the psychological pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount of money. Think about what that means for a moment. If your portfolio goes up $10,000, you feel good. If your portfolio goes down $10,000, you do not feel half as bad as you felt good. Feel twice as bad. The downside pain is disproportionately large. And your brain's number one job, the job it has been doing for 200,000 years of human evolution, is to make pain stop. Selling feels like making the pain stop, feels like doing something, feels like taking control. And in almost every other area of human life, taking action when you are in danger is the correct move. You do not sit still when a car is coming toward you. You do not remain calm when there is a fire in your building. You move, you act, you protect yourself. Our brains are wired for action under threat, because in the ancestral environment, action was almost always the right answer. But financial markets are not the ancestral environment. They operate on completely different logic. And the action that feels protective selling is very often the action that causes the most damage. Here is the brutal mathematical reality of panic selling. In order for it to actually protect you, you need to be right twice. You need to sell at or near the bottom before the market recovers. And then you need to buy back in at or near the bottom before the rally fully takes off. Miss either of those timing windows, and you are worse off than if you had done absolutely nothing. And here is the thing, almost nobody gets both of those calls right. Not professional fund managers. Not algorithmic trading systems. Not anyone. The market does not ring a bell when it hits the bottom. It does not send you a notification when it is safe to come back in. By the time it feels safe, the recovery has already happened. There is research from JP Morgan that I find genuinely alarming to look at. They studied the S&P 500 over a 20-year period, 2 full decades of market returns. And they found that if you missed just the 10 best trading days in those 20 years, your overall return was cut nearly in half. Not a little bit, nearly in half. If you missed the 20 best days, your returns essentially collapsed to near zero. And here is what makes this so relevant to what we are talking about. The best trading days, the biggest single-day gains, very often occur right in the aftermath of crashes. They happen during the recovery from exactly the kind of fear events that cause people to panic sell. The investors who left the market during the panic missed those exact days. They protected themselves from nothing and gave up everything. There is also a cognitive phenomenon called the availability heuristic. It means that when vivid, frightening images dominate your awareness, and in a war, those images are everywhere, on every screen, in every conversation, your brain treats the worst-case scenario as the most probable one. The cognitive weight of the frightening images inflates your perception of risk far beyond what the actual probability of catastrophic economic collapse would justify. Your risk assessment becomes uncalibrated. You are not actually evaluating probability. You are responding to emotional intensity. And the modern media ecosystem is perfectly designed to maximize that emotional intensity because fear drives engagement and engagement drives revenue. The financial news media during a geopolitical crisis is not a neutral information source. It is an anxiety amplifier. The sooner you understand that, the better investor you will be. Now, I want to be very careful here because I am not going to sit here and tell you that selling is always wrong under every possible circumstance. That would be intellectually dishonest, and you deserve better than that. There are situations where reducing your equity exposure during a geopolitical crisis is the correct decision. But they are probably not the situations you think they are. The first legitimate reason to sell is if your portfolio was already miscalibrated to your actual situation before the crisis hit. Let me be specific about what I mean. If you are 65 years old, you are retiring in 3 months, and you need to start drawing down your investments to live on, and you had 90% of your portfolio in equities, that was already a problem. It was a problem before the war started. The crisis just revealed it. In that scenario, yes, reducing your equity exposure makes sense. But you should have done it regardless of geopolitical events. The war is just the trigger for correcting a pre-existing misalignment between your portfolio and your life situation. The second legitimate reason is concentrated exposure to companies or sectors that are genuinely, fundamentally impaired by the conflict. Not just sentiment affected, but actually impaired. There is a difference. If you own a significant position in a commercial airline that operates heavily through a conflict zone that has now been closed to air traffic, that company's business has actually changed. Its revenue streams are actually disrupted. That is a fundamental consideration, not an emotional one. But notice that this is a very specific, targeted analysis of a particular holding. It is not a reason to sell everything and go to cash. The third exception, and this is the one people most often invoke to justify panic selling, even though it almost never actually applies, is the scenario where the conflict is so catastrophic, so civilization-allied destabilizing, that the global economic order itself is at risk of collapse. A full-scale nuclear exchange. A conflict that permanently destroys global supply chains. A war that ends modern civilization as we know it. And here is my honest response to that scenario. If that is actually happening, your stock portfolio is not your primary concern. Cash is not going to save you. Gold might help for a while. But your personal safety, your physical location, your access to food and water and community, those are what matter in genuine civilizational collapse. Preparing for that scenario is an entirely different conversation, one that stock market strategy is essentially irrelevant to. If you are using that fear to justify panic selling in a regional conflict, you are not actually thinking clearly about the probabilities. For the vast, overwhelming majority of conflicts, even serious, scary, deeply destabilizing ones, the case for panic selling evaporates when you hold it up against the historical evidence. Alright, so if selling is usually the wrong move, what should you actually do? Let us get concrete. Here is what disciplined, long-term investors actually do when geopolitical crises hit, the moves that have consistently protected and built wealth over decades. The first thing they do is nothing. And I want to be really precise about what I mean, because doing nothing is not the same as being passive or checked out. Doing nothing is an active, deliberate choice. It means looking at your portfolio, confirming that your allocation still matches your actual time horizon and risk tolerance, and then making a conscious decision not to change anything. It means having the discipline to not react to the noise. Warren Buffett has said that his favorite holding period is forever. Peter Lynch, one of the greatest mutual fund managers of the 20th century, famously said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has ever been lost in the corrections themselves. Doing nothing with conviction, with intent, with a clear understanding of why is a strategy. And historically, it is often the best one available. The second thing smart investors do is use the dip as a buying opportunity. I know that sounds almost recklessly contrarian when you are in the middle of a panic. But think about what a market decline actually represents. It is every company you already believed in, now available at a lower price. If you were willing to own a broadly diversified index fund last month, you should be even more willing to own it when it is trading 10% lower. The underlying businesses, their products, their employees, their customers, their technology, their real estate, did not disappear because a conflict broke out somewhere in the world. Their stock prices dropped because of fear and uncertainty. And fear, historically, has been one of the most reliable buying signals that exists in investing. The people who bought during the worst moments of the 2008 financial crisis, the COVID crash of 2020, the sell-offs after September 11th, those people made extraordinary returns over the following years. The third move is thinking about sector rotation rather than total capitulation. Wars do create real winners and losers in specific sectors, and if you want to make active portfolio decisions during a conflict, tilting toward historically war-resilient areas is far more defensible than going to cash entirely. Defense stocks almost universally spike when conflicts escalate. Energy prices rise when supply chains are threatened or when major producing regions are destabilized. Agricultural commodities surge when significant farming nations are involved. Gold tends to rise as a safe haven. If you want to do something, if your personality absolutely requires action, then thoughtful reallocation within equities is a more rational choice than wholesale liquidation. The fourth move, and one that does not get nearly enough attention, is reviewing your liquidity position. Not your investments, your actual liquidity. A crisis is a good moment to make sure you have 6 to 12 months of living expenses sitting in cash or cash equivalents outside of your investment accounts. The reason this matters is subtle but important. The most dangerous thing for a long-term investor is not a market decline. It is being forced to sell investments during a market decline because you have a personal financial emergency at the same time. If you lose your job, if a major expense hits unexpectedly, if a health crisis drains your savings, and your only option is to sell stocks at a depressed price to cover those needs, that is when a temporary market setback becomes a permanent loss. A proper emergency fund insulates you from being forced into that position. It is the single most underrated risk management tool available to any investor. The fifth move, and honestly, this might be the most important of all, is having a written investment policy in place before the crisis happens. Before the war, before the crash, before the panic. Write down your time horizon. Write down your target allocation. Write down the specific circumstances, if any, under which you would change your portfolio. When you make those decisions in a calm, rational state, you are drawing on your best thinking. When you try to make them in the middle of a geopolitical panic with markets down 10% and the news channels running split-screen footage of missiles and stock tickers, you are drawing on your worst instincts. Having a written plan that you committed to in advance is like a contract with your calmer, smarter self. It is a way of protecting your future decisions from your present fear. I want to zoom out for a moment and talk about something that gets lost in these conversations about market tactics and timing strategies. Because I think there is a deeper truth here that is actually the most important thing I am going to say in this entire episode. The question of whether to sell stocks when war starts is really a question about what stocks are and why they grow over time. And when you understand the real answer to that question, the tactical choices become much clearer. Stocks are ownership stakes in human enterprises. Not abstract financial instruments, not numbers on a screen. Real businesses, run by real people producing real goods and services for real customers. And human enterprises, across the entire sweep of recorded history, have shown an almost stubborn, relentless tendency to survive, adapt, and grow, even in the most extreme circumstances imaginable. Companies found ways to operate during the Great Depression, when unemployment hit 25%, and the global economy contracted by a third. They found ways to produce, innovate, and profit during World War II, arguably the most destructive conflict in human history. They rebuilt after September 11th. They restructured, recapitalized, and grew after the 2008 financial crisis, which was the worst economic shock since the Depression. They pivoted, innovated, and in many cases thrived during a global pandemic that killed millions of people and shut down entire economies for months. This is not optimism. It is an empirical observation about the extraordinary resilience and adaptability of human economic activity. If you believe, as I do, based on the evidence, in the long-term growth of human civilization, if you believe that human beings will keep building things, selling things, inventing things, solving problems, then you fundamentally believe in the long-term upward trajectory of equity markets. Because equity markets are nothing more than a mechanism for participating in that growth. Wars are terrible. They cause immeasurable human suffering. They destroy lives, cities, cultures. But in the context of the long arc of economic history, they have not reversed the underlying trajectory of human progress. They have bent it temporarily. They have not broken it. Not once. Not in 100 years of catastrophic conflicts. The investor who pulled everything out of markets after Pearl Harbor and never returned missed one of the greatest bull markets in American history. The extraordinary post-war economic expansion of the 1940s and 1950s that built the modern middle class and transformed the United States into the world's dominant economy. The investor who held on, or who kept investing systematically through the fear, built generational wealth. That is the real cost of panic selling. It is not just the loss you lock in at the bottom. It is everything you miss on the other side. Let us bring everything together into a practical framework you can actually use the next time a crisis hits. Because there will be a next time. There is always a next time. First, impose a mandatory waiting period on yourself. Before you make any major portfolio change during a geopolitical crisis, give yourself at least 48 to 72 hours. Markets almost always overreact in the first 24 hours of a shock. The very worst time to sell is during that initial panic window. If you still feel the same way after 3 days of calm reflection, you have at least made a considered decision rather than a reactive one. Second, ask yourself honestly whether your actual financial situation changed. Not your emotional state, but your real situation. Did your income change? Did your time horizon change? Did your actual need for the money change? If the answer is no, the case for changing your portfolio is very weak. If the answer is yes, if you genuinely have less time before you need the money or less income stability, then make adjustments based on those concrete realities, not on fear of a conflict that may be over or contained within months. Third, consider whether there is a tax loss harvesting opportunity. If your portfolio is down significantly, there may be a legitimate financial reason to sell certain positions but not to go to cash. To realize the loss for tax purposes, and immediately reinvest in a similar but not identical holding to maintain your market exposure. Done correctly, this strategy gives you a real tax benefit without actually reducing your participation in the eventual recovery. It is one of the very few reasons a responsible financial advisor might recommend selling during a downturn. Fourth, if you are managing significant wealth and you do not already have a relationship with a fee-only fiduciary financial advisor, get one. Not a commission-based broker. A fiduciary is legally required to act in your best interest. A commission-based broker has financial incentives that are tied to your trading activity and that are not aligned with your long-term well-being. In a crisis, that distinction matters enormously. Fifth, and finally, turn off the financial news. I am completely serious about this. The financial media during a geopolitical crisis will make you feel like the world is ending on an hourly basis. That is not because the world is actually ending on an hourly basis. It is because that emotional intensity drives the engagement that drives their business model. The information you need to make good long-term investment decisions is not coming from cable news. It is in your financial plan. Read that instead. Let us come back to where we started. You wake up. The world is on fire. Your portfolio is red. And every instinct you have is screaming at you to do something. Here is what I want you to remember in that moment. The investors who acted on that instinct, who sold into the panic after Pearl Harbor, after September 11th, after the Gulf War, after every crisis we have talked about today, almost all ended up worse than the investors who did nothing. The market recovered. It has always recovered. And the people who held on, who kept their money working, who stayed the course when it was hardest to do so, Those are the people who built wealth across a lifetime. The hardest thing about investing is not the math. The math is simple. The hardest thing is managing yourself, your fear, your instincts, your very human need to feel like you are doing something when everything around you feels out of control. The discipline to sit still while the world is panicking. To trust the plan you made when you were thinking clearly. To know the difference between information that should change your strategy and noise that is just trying to get your attention. That discipline is the real edge. It is available to every single investor, regardless of wealth or experience. And it is what separates the people who use the market to build a better life from the people who use it to make their fear feel temporarily better. Thank you for spending 20 minutes on this with me today. If this episode helped you think more clearly about something that genuinely matters, share it with someone who might need to hear it. Take care of yourselves, and I will talk to you next time.